Hey, everybody, and welcome to Money Talks News, the podcast. In this episode, we're talking about getting ready to buy a house even if the market sucks and rates are high. Existing home sales surged 9.5% in February, the largest increase in a year. With home sales strong, we're not likely to see prices come down anytime soon. Combine that with relatively high mortgage rates, and it's definitely not a buyer's market. But what if you're ready to buy a home anyway? What can you do to best position your finances to get ready to buy a home no matter what's going on in the market? In this episode, we welcome back friend of our show, Mindy Jensen from BiggerPockets. Hi, Mindy.
Hi, Stacy. I'm so excited to be here.
You're just an excited person, period. You're a very
Guilty.
happy woman.
Yes, but I love talking about money and real estate. So this is like the perfect storm of my favorite stuff.
And correct me if I'm wrong, Mindy, but you are a professional real estate agent.
I am
or broker.
for 10 years.
I don't know.
In Colorado, we are called real estate brokers, but everybody is a real estate broker. But you can say however you want to call it.
I want to call you a real estate expert.
Ooh, I like that the best.
And when last we spoke, we were talking about buying houses, and you had just bought one, I believe. You live outside of Denver?
I do. I live just north in a city called Longmont.
And you were just buying. You buy houses and fix them up and flip them. Is that right? You live in them, though.
I live in them. It's called a live-in flip, and I buy a really ugly house. I move into it. I make it look beautiful over the course of at least 2 years, and that's very important because Section 121 of the tax code says that I don't have to pay any taxes on the gain up to $250,000 per person on title. So $250,000 if you're single, $500 if you're married, or if, like me, you have a kid who's about to turn 18 and you have created such gains in your house that you are going to have to pay taxes, you could put your kid on title and exempt $750,000 of gain from taxes.
I did not know that.
Oh my gosh.
That is something that I just learned from my friend and tax expert, Natalie Colity.
And
that's awesome.
Yeah.
Interesting.
That's really interesting. We'll definitely be linking to your past episodes that we've done with you on how to do a fix and flip and all of that good stuff.
How ugly are these houses? Do they have roofs? Do they have running toilets? I mean, how ugly are they?
We talked about that in another episode, guys. we haven't
really quickly though. This house was a shrine to 1978, and they smoked in it since 1978.
Wow.
So nobody wanted this house.
I actually owned that house.
Well, thanks for taking such crap care of it, because now I'm going to make a lot of money off of it.
I used to smoke in my house. Now I don't smoke at all, but I remember people they would go outside to smoke. And I'm like, what the hell are you talking? It's your house. You own it. You can smoke in it. And now nobody smokes in their house. And nobody smokes in this house, I'll tell you that. Anyway, let's talk about the topic at hand. I have to go back and look at the title of this podcast, see what it was. Oh, yeah, that's right. Buying a home in a crappy market. So this has to be the worst market ever for buyers, isn't it, Mindy?
I don't know that it's the worst ever for buyers, but it's definitely one of the worst. So I remember spring of 2022 when the Fed had indicated they were going to raise rates, but they hadn't taken effect yet. And we've got all of this pent up demand from people, during COVID who may or may not have been looking at houses, coupled with, rates are going to go up. I better buy now. And that was literally the hottest market I have ever been a part of. And houses were coming on the market in my area on Thursday. Showings started Friday. They were Friday, Saturday, Sunday. Offers were due Sunday night with a response of Monday. And then the next week, that neighborhood, prices were up $10,000 a house. And I watched how prices march up. Houses were going over asking, no contingencies, all cash, blah, blah, blah. And it was a really terrible market. But then in June of 2022, the Fed said, remember how we said we were going to raise rates? We're going to jack those way up. And the housing market, at least in Colorado, came to a slamming stop. And then started a little bit, people who couldn't get in on the super low rates were still getting in on these 5% rates. But the rest of 22 was kind of bad. 2023 was down a little bit. And as you said in the beginning, existing home sales surged 9.5% in February. I don't expect those to go down anytime soon, simply because we have an inventory and supply problem. And really quickly, inventory means houses for sale right now. Supply means all the houses in the country. So we stopped. I don't know if you remember back in 2008, the economy took a tiny little dip. It was a small story. You might have missed it. But we stopped building houses in 2008. And we didn't build them in 2009, 10, 11, 12. 13 into 14 and even 15, depending on the area. So that's a whole lot of years of no additional supply. So we have between 4 million and 8 million housing units short in America, depending on who you're talking to and where you're getting your information. But either way, we don't have enough houses for the people that want to buy houses. Coupled with high interest rates, that keeps some buyers out of the market.
In fact, I was just reading an article yesterday. Maybe it was on our website. I've forgotten where. But there's only there are a few markets in the United States where you can buy a house with income of less than $100,000. I could be totally wrong about quoting that, but there was something like that. I mean, you have to have a ton of income now to buy a house because houses. It's really weird that when interest rates went up, housing prices didn't go down. I understand why, because you just explained it. Because of lack of inventory. But what do you do? You buy houses. What are you going to do in this situation where rates are high and inventory is short?
Well, right now, I haven't bought a house since June of 2022. I mean, it's not been that long ago, but I am keeping an eye on rates. I'm keeping an eye on house prices. The issue is when rates started going up, prices did not decrease. And the reason is the inventory supply. So demand is down, inventory is down even more. So let's go back to, June of 2021 when interest rates were like 3%. You buy a house and then you decide, I don't really like this house. Let's go back a little bit further. Let's go back to, 2019. You buy a house and you get a 3% interest rate. Oh, okay, this is great. I love this house. Oh, you know what? It doesn't meet my needs anymore. I'll sell it and buy another one. It doesn't matter because you can still get a 3% interest rate. But now people who have those 3% interest rates aren't selling their houses. They're staying put because they would go from like $1,500 mortgage payment to $5,000 mortgage payment. It's a lot easier to redo your house when you know you're going to be coming out of pocket way, way, way more for that new house. So that's where the inventory department is very, very low. And then the supply we already talked about, there's no houses to buy. People aren't selling them. It's just this like perfect storm that isn't going away anytime soon.
Have the Airbnbs and the corporations buying up a bunch of houses for rentals, has that put inventory pressures on there, or is that not really a big of a number?
There's so many different factors putting pressure on the housing supply and the housing inventory that it's not just one thing. Because if it was one thing, we could fix that and then have a better supply and have a better inventory. But it's so many things. But absolutely, people buying rental. I have one house that I live in and one rental property. But there are people who have 20 rental properties, 50 rental properties. So that takes away the ability for somebody else to buy a single family home when it's not available.
Well, do you mind if I set the stage here so we can bring our listeners into this? Because let's talk about Miranda. Now, Miranda has always wanted to buy a house. She loves buying houses. She lives for house buying. So let's say that Miranda is going to finally pull the trigger. She waited until the market sucked, but now she's desperate for a house. Right, Miranda?
Sure. For the auspices of this particular thing, sure.
We can edit that right out of this podcast. So anyway,
no, leave it in.
Okay. The joke here, guys, is that Miranda is a renter and a proud renter, does not want to be a homeowner. That's why I made her the subject of this example. But okay, Mindy's your realtor. What are you going to tell Miranda to do, Mindy? How could she beat this horrible market?
First of all, tone down your desperation. Being desperate to buy a house is when you start feeling FOMO and you start making offers that don't make sense, not to you, not to the market, and not to your financial situation. Miranda is a renter and a proud renter. She can continue to be a proud renter. Don't get caught up in this, oh, houses are going up, I have to buy. If you don't want to own a house, then don't buy a house. First and foremost, look at why you want to buy a house. But putting that aside, let's say that Miranda actually does want to buy a house. Miranda needs to look at her financial situation and how much she feels she can afford as a mortgage payment. Let's go with $3,000. Miranda may have amazing income that qualifies her to pay $5,000 a month for a mortgage payment, but Miranda is financially savvy and doesn't want to pay that much. So she looks at $3,000 is comfortable for me. She needs to turn that into a reverse mortgage, not a reverse mortgage, but a reverse mortgage calculator situation. So she is only looking at houses that give her a $3,000 mortgage payment. I don't care what your lender says. You need to be comfortable with this. And because rates are so quote unquote high, she needs to be comfortable with this mortgage payment forever. So if $3,000 feels good to her, that's where she should be looking. I see people who say, oh, rates are going to come down. $3,000 feels good. $4,000 is what I'm qualified for. I'm going to look at the $4,000 and I'll just refinance when the mortgage rates come down. Okay, when are mortgage rates coming down? Everybody look in your crystal ball and email me because I want to know when they're coming down. The thing is, inflation numbers keep coming in hot. Unemployment numbers keep coming in low. All of these factors are telling the Fed you don't have to lower rates right now. And I don't have a crystal ball myself, which is why I'm asking everybody to share it with me. But I don't know when they're going to come down. They might not come down for years. So if $3,000 is comfortable and $4,000 is a pinch, you have to be comfortable with your mortgage payment, assuming that it's never going to change. So that is my first bit of advice to Miranda. And if anybody else listening happens to find themselves in the same situation, how much is it comfortable for you to pay in a monthly mortgage payment? And don't look any higher than that. You also want to
Mindy,
get a...
I don't want to put you on the math spot here, but if we've got a 20% down payment, how much house could we afford now for three? I'm going to talk really slow because I can see you punching on your computer.
I was going to say, who's actually using a
calculator.
20% down payment? Nobody's using a 20% down payment.
You think they're using less?
Oh, yeah. Most.
Okay, so very quick math, and this is principal and interest only because I don't know what your taxes are and I don't know what your insurance is. Your homeowner's insurance is going to be, but principal and interest only. A $400,000 loan for 30 years at 7.726% is $28.59 per month.
Okay.
So
she could buy a $480,000 house, put down 20%, and have about a $3,000 a month mortgage payment, not including principal. I mean, it's just principal and interest, not including taxes and insurance.
That'll get you a studio apartment down here.
Yeah, $400,000 to $500,000, depending on where you are. In New York City, that's probably not going to get you anything. In the suburbs of Chicago, you could probably get a nice house there. In my area, you'll be in a condo. And notice I said principal and interest. You have property taxes that you're going to pay, or the city is going to repossess your house or foreclose on your house. You have homeowner's insurance that your mortgage company will absolutely make you pay. My homeowner's insurance is $2,000 a year. So if you divide that by 12 months, my calculator is not that fast. That's $166 a month. So you've got your $166 plus your $28.59. Now you're at $3,025. If you have low property taxes like I do, they are $3,000 a month. I'm sorry, $3,000 a year divided by 12 is $250. So now you're at about $3,200 a month. If you live in a place like Wisconsin, where they have exceptionally high property taxes, When I moved out, my property taxes in Wisconsin were $17,000 a year.
You're just proving the going articles out there. They're telling everybody that renting is cheaper than buying right now.
I was actually just going to ask that, Aaron, because I read these articles too. It says in most of the country now, it's cheaper to rent than it is to buy. If you live in one of those places, Mindy, do you ignore that if you want to buy, or do you not buy even if you really want to? What should Miranda do?
Well, let's say that Miranda lives in New York City and she's going to have to pay $10 million for a property, which is just making up stuff. Or she could rent for $2,000 a month. I mean, none of these numbers are correct, but why would she pay so much when renting is clearly so much less? And, there are people who never want to own a house. That's a valid option. I think there's so much shaming in this country. Oh, the American dream is buying a house. Not if you don't want to own it. You have to take care of it. You have to fix things. I have a rental property. I have a tenant in there right now for 45 days because it's a medium-term rental. In the time he's been there, the shower flooded, the toilet handle broke, and the P-trap came off of the sink and flooded the kitchen. And those are not exciting things for me, but I know how to fix them. They're not that big a deal. But if Miranda doesn't know anything about plumbing, all of that would have cost her, I don't know, $1,500, $2,000 for just those three things in the first 30 days that this guy was there. And I feel terrible about it. It's like these weird fluky things and now they're all fixed. But, and that's not even, I'm trying to think of all the things that I have fixed in my house. I had to buy a new refrigerator. My oven broke. The things break.
If you run out of things, let me know because I'm doing the same thing.
Well, I think,
and by the way, I can't see Miranda right now, but I know she's gloating. You're gloating right now, aren't
just
you?
A little bit. But I think the key here, when we're talking about deciding whether we're going to buy a home in a crappy market, right? Because timing the market, no matter what market you're trying to time, rarely works well, right? Occasionally somebody's going to hit it, but it's going to be hard. So I think the real key is to say, why am I buying this house? Am I buying it to live in? So if I'm buying it to live in, then you're like, okay, I'm going to suck it up for now and maybe I'll refinance later. If you're buying it because you want cash flow, that's a rental property, right? So you're going to suck it up and you're going to buy it for the cash flow, maybe refinance later, but you're going to try and get that cash flow to cover most of your costs. And if you're buying it for profit, that you're flipping it, you're planning on flipping it later, you're buying it because you're hoping that that the prices, that home values are going to rise enough in the next 2 to 3 years that it's going to be able to give you some profit even at these higher rates. So really the idea is, why am I doing this? And do I know the numbers involved for my personal finances? And have I run the numbers to see if this makes sense for me?
So Mindy, you said the last time you bought a house is in 2022?
Correct.
And it's been roughly almost 2 years. So are you getting ready to do it again, or are you not in this market?
I always have an eye on the market. I have, because I'm an agent, I have access to the MLS and I have set myself up to receive listings as they come in, both to keep on top of what's going on in the market so I can help my clients, but also because maybe there's some smoking hot deal that is going to come up. And I don't want to miss out on a smoking hot deal. And we have always wanted to have a ski house, but houses out by Breckenridge, which is like world-class skiing, they start in the millions. So we haven't really been super proactive with that. But we just discovered a new mountain. I don't even want to say it because people will flock there, but it's called Monarch Mountain. It's just outside of Salida, Colorado. And we are now looking at a second home / rental property down there that we can stay in when we go snowboarding at Monarch Mountain. So I'm looking at different options. I have lenders that I work with on a regular basis, but the rates are so high that I might just sell some of my stock portfolio to buy a rental house. I might borrow against my stock portfolio to buy a house. And then if rates come down, I can go and refinance. But that's if. I didn't say when rates come down.
Okay. So
Yep. Go ahead, Aaron.
well, I was just saying. So you're working on houses that need a lot of TLC, but now you're also talking about pulling the money out of the market. So you're saying, okay, the one way I'm getting around the high interest rate is I'm going to pay cash, or a huge lump sum down and probably buy points.
I am going to, it would be essentially paying cash. And I'm not actually pulling money out of the stock market. I'm borrowing against my stock portfolio, my after-tax stock portfolio with a line of credit.
Okay.
Oh, so you're doing a margin loan?
No.
Yes.
Kind of.
Yes. Kind of.
So
I don't understand. Go ahead.
Well, so generally a margin loan is what you use to buy more stocks with. She's just using her equity as collateral.
No, a margin
like a
loan is just
HELOC.
borrowing against your stocks. You can do anything you want with the money.
Fair enough. Okay.
Yes. It's like a HELOC against my after-tax stock portfolio.
That seems like risky business to me.
Oh, you want to hear a fun little story? It can be risky business depending on what's in your stock portfolio and what the market is doing. So we are tech heavy and we are Tesla heavy, and Tesla is incredibly volatile. I don't know if you've seen the news. We borrowed against our stock portfolio to buy the rental house that we have now because we needed fast cash. We didn't want to deal with the getting a loan because rates were 5%. Oh my goodness. So we borrowed against it, and we had a rather sizable gap between what our portfolio was and what our portfolio
what you could borrow against. In other words, you're going to tell me you got a margin call.
I didn't get a margin call, but I narrowly escaped a margin call. So yeah, that is one of the risks of this margin loan. And I'm trying to remember all the correct phrasing here, so bear with me. But we had a buffer of this much, and then we borrowed, and we still had a buffer of like this much. So we watched the stock market kind of march down in 2022, where it went down and down and down, and my buffer keeps getting smaller and smaller. And we started thinking, hey, what happens if our buffer goes away? Well, then the company that gave us the margin loan will sell stocks that they choose, not stocks that I choose. So we went and got a HELOC against our primary residence just in case. We didn't take any money out, but we got it just in case. And we ended up at the end of 2022, beginning of 2023, throwing $100,000 into that stock portfolio to pay off $100,000 of the margin loan to give us so that they didn't call us out.
Yeah.
They would have called us out for about 3 days. We went negative or inverted on the amount that we could borrow. And then it started climbing back up again. And that was a little bit scary, but also we have a lot of buckets to pull from. So this is definitely not a beginner level strategy. It's an option. I consider it a short-term option until, you can figure out your financing or whatever. But we almost got a margin call.
The problem with the margin loan is that they vary with rates. So as rates go up, your margin loan interest goes up too.
Wow, what a great thing to point out. Because yes, when we got the margin loan, it was 1%. And now it's hovering around 7%.
And I think that's important too when we're talking about all of this stuff. When you're talking about why are you buying the house, what are you going to do with the house, and do you have a plan, right? Like Mindy, you and Carl have a plan, and you guys have backstops, and you guys know your risk tolerance and all of that. And that's also part of the equation when you're trying to decide, all right, am I going to go for it in this crappy market?
Yeah,
exactly.
And actually, let's talk about that, Miranda, because what you've decided is that even though the market sucks and it's going to be very difficult, and you're not sophisticated enough to do a margin or anything like that, you looked at the market and you said, screw it, I'm going forward. I'm going to buy a house. I really need it because everyone knows how bad you are hankering for a home. Okay, so now what are you going to do now, Mindy? You're the agent. Miranda says, I don't care what the market is. I need to own a home, and I need to own it now. How can she prepare herself?
Well, Miranda said it best. Have a plan. Have a financial plan. Know what your limits are. Know what your cap is, and don't exceed it. So one thing that I have discovered with real estate agents is if you tell them my price range is $400,000 to $500,000. Sometimes they'll go a little bit more. Oh, I'm going to show you houses at $525,000, $550,000. No, tell them, no, I don't want to see houses that are more than $500,000. That's my cap. And then because a $550,000 house is typically a much nicer house than a $400,000 house. And once you start seeing these 550 houses, you might look at the $400,000 house and be like, it's okay, but that 550 is awesome. And your mortgage payment goes from $3,000 a month to $3,750. And, what's $750? Well, every single month that adds up. And if you're comfortable with $3,000, you might not be comfortable with $3,750. So don't listen to your real estate agent and your lender when it comes to pricing and mortgage payments and things like that. Listen to yourself. Look at what you can afford. And if what you can afford isn't attainable in your market, don't go up just because that's what your agent is telling you. That's what your lender is telling you. Really think about what you can afford. And not everybody can afford to buy a house. And that is a reality that isn't fun to talk about, but it's still a reality. So just because Miranda can afford the $5,000 payment, but she wants a $3,000 payment, doesn't mean she should just suck it up and take that $5,000 payment. I mean, rates could stay like this for the next 10 years or longer. We never know what rates are going to do.
Mindy, so I'm sorry to cut you off. Go ahead and finish your thought.
Oh, no, please cut me off anytime because I talk forever.
I wanted to ask you something. I was thinking about this today. My first house that I bought was 1978, and that was in Tucson, Arizona. And what I learned to do, and I bought a few properties since then, maybe a dozen, and what I learned to do back then was to try to determine what the seller wanted. In other words, some people want price. Some people want cash. And so what I did with this, I was buying this house from a doctor who was about to go into the Army. And he didn't care about the cash because he was going in the Army. But he did care about the price. And so what I did was I said, I will pay your price. However, you will carry back the mortgage at a very low interest rate. So in other words, I found out what he wanted, what his hot button was, which is difficult to do when you've got two agents in between. I was dealing directly with the seller. But I guess the question I was going to ask you, do people still carry back?
People can carry back, but your mortgage company doesn't want your mortgage connected to the house when you're not the owner. So there are ways to get around that. But again, that is a very non-beginner level way to buy a house. When you do, the easiest way to have somebody carry your mortgage is when they don't have a mortgage themselves. And like you said, knowing their motivation can be really huge. I just looked up 1978 mortgage rates, and they were 9.64% on average.
Yeah.
Which is, into the 80s, they were even higher than that. They got into the double digits rather quickly. And that makes sense for you to be able to negotiate with them. A lot of sellers aren't knowledgeable about carrybacks.
Yeah, actually, for example, I own this house and I'm sitting in free and clear. If Miranda wanted to buy this house from me, and interest rates are 7.5%, on a mortgage, she could come to me and say, I will buy your house for $1 million, and you carry the loan at 5%. Now she's only paying a 5% mortgage, and I'm getting 5% on my money, which would be difficult for me to do at a bank for the next 20 years, for the rest of my life. So that could be a workaround. But I guess what I was asking is, this is something I would have done 30 years or 40 years ago. But I don't know if does that even work now? Can you approach somebody with a free and clear home and say, I want you to carry the mortgage back?
So you can, but the most success that you're going to have is when you know what you're talking about. So if this is something you want to consider.
In that case, I'm out.
If this is something you want to consider, educate yourself so that you can sell it to the seller. Because the seller may not have any idea what you're talking about. Oh, I'm not a bank. I don't want to hold the mortgage on this. Well, wait, let me show you how this works. There are tax advantages because, Stacy, when I buy your house for $1 million, you just got $1 million. And that's probably going to be over that $500,000 cap or $250,000 cap that on your primary residence that I talked about earlier. Or maybe it's not. Maybe you bought it for $900,000 and you're only going to have $100,000. But a lot of these people who own their house free and clear have owned it for a long time.
Right.
They may not be really savvy with finances or with real estate or with both. So you need to be able to discuss this with them, talk about the tax advantages, because the money you get in that tax year is the taxes that you're talking about.
Right.
So talk about the advantages. Talk about how it can provide them with income. Talk about how you're going to cover all of the costs of doing this, which is really not that expensive.
Yeah, way cheaper than getting a mortgage.
Exactly. You are the one who is benefiting. The seller is now still attached to this house, and seller financing isn't going to work for everybody. If you own this house for 35 years and your mortgage is paid off and you're selling it to go buy another house, you might need that money that's tied up in the house right now to go buy the next house, and seller financing isn't an option for you. Or maybe you don't need that money and seller financing would be a great option. And it goes back to your point, Stacy, about how you need to know motivations for the sale in the first place.
Yeah, because you could, first of all, you've got to have an agent that's sophisticated enough, like you, to understand that this is even a possibility. Because I tried to do this when I lived in Ohio years ago. Here, let's have the seller carry back something. The agent said this. Duh. They had no idea what I was talking about. They didn't, because it used to be, there were spaces in contracts where you could actually write shit like this, and now the contracts are you just fill in how much you're going to pay. And, it's just basically, there's not even room to write stuff like this. You have to almost have a custom contract to do it. But there are always techniques to get what you want.
Yes. And the underlying message that I want to share with people is educate yourself about these different options so that you can then educate others. Because I can tell you, your seller almost guaranteed isn't listening to this episode and they don't know anything about this. And it might be very attractive to them or it might not. But you need to be able to sell this to them in order for them to want to buy into it.
Now, if I asked you as my agent, could I say, Mindy, I only want you to show me houses that are free and clear? Could you even determine that?
I would have to dig into my MLS to see. There are ways to do it, but it would take a little bit of work. And not to say that I wouldn't do it. I would just have to dig into that. But it's certainly easy enough to figure out. You look at the public records. You can get all sorts of different types of lists that you can then mail to those people who are free and clear, even if they're not on the market. Hey, I'm looking for a house where the seller carries the mortgage. If you know of anybody or if you are thinking of selling your house, I'd love to talk.
Cool. Obviously, I'd have to get a substantial down payment to make sure my house is, but why wouldn't I lend against my house? But anyway, I didn't mean to dominate the conversation with this one technique. I just thought, that's something I used to do, and I just wondered if it was still possible to do now. And that is a way to get around high interest rates. Obviously, in very unique situations. Also, aren't there assumable FHA mortgages out there?
So FHA and VA mortgages are assumable, but there's it sounds great, but it can be a bit of an issue. So let's start with VA because basically the rules are the same, but people are saying, oh, well, I don't qualify for a VA loan, so I'm not going to listen. VA mortgages are assumable by anybody, even if they're not allowed to take out a VA loan because they're not a veteran. However, it has repercussions for the original VA borrower if you are a non-VA borrower trying to assume their mortgage. So, but both of them come with essentially the same rules. It has to be your primary residence. This isn't for rental properties. And you have to be able to cover the difference in the mortgage. So let's say you've got a mortgage on a property, the remaining balance is $250, but Miranda is buying it for $400. She has to come up with $150,000. It's also an arduous process. So it takes between 3 and 6 months to assume a mortgage. There are companies that help you with the assumption process. It's still kind of new because back when mortgage rates were 3%, nobody bothered assuming your mortgage because they're just going to go get their own at the same rate.
Right.
But now that rates have gone up so much, this is becoming more of an option.
Yes, and people don't talk about it, though. I don't hear anyone talking about assuming mortgages. I bet most people don't even know it's possible.
I would bet most people don't. I would bet most agents don't. And like I said, it's kind of a process. So Miranda has to convince you, Stacy, to sell her your house with your assumable mortgage. And let's say your assumable mortgage has an $800,000 balance. Miranda, first off, has to qualify for that balance. And then she has to bring $200,000 to closing. Right. And at $1 million, maybe she has that kind of funds. But in the lower price ranges with a, first-time home buyer, they might not have the funds to come up with the difference. And now you want $1 million for it. Maybe Aaron can pay you $1 million today. He doesn't care about your assumable loan. Why would you wait 3 to 6 months to help out Miranda, who in this theoretical scenario you don't even know, when you could sell it right away? So Miranda is going to have to make it worth your while. Maybe she has to pay a little bit more. Mm-hmm. And it's worth it to her to pay more than the $1 million because her rate is so low, or your rate that she would assume is so low. Right. So there's a lot of moving parts coupled with the fact that real estate agents aren't really all that aware of this, don't know how it's done, haven't done it themselves. I mean, I've never done a mortgage assumption before, but I have a really great partner who has. Her name's Libby, and she's awesome. So I would look to her for guidance. It can be done. I know that it has been done, but it is a process. So I would liken it to a short sale process where it's going to take a long time and you need a lot of patience. And people right now don't really have a lot of patience.
Yeah. Well, just for the record, though, folks, I've come up with 2 ideas where you can beat high mortgage rates.
Yes.
Neither one of which is easy, but they do exist. And as you pointed out, Mindy, this is why, before I bought a house, here's what I did. I rented a place from my landlord, owned 75 houses. And I followed this guy around until he got a restraining order out on me.
Amazing.
Because I want to know what he knows, And this is how I learned this stuff, just by asking people questions, reading books. And next thing you know, you can find yourself in an advantageous position because most people don't bother to do that.
Exactly. The easiest way to buy a house is to get a conventional mortgage that you can totally qualify for through a traditional lender and make a great offer on the house with your real estate agent going to their real estate agent. That's like the way to do it. But that's not the only way to do it. So if you're thinking, I can't afford a house in this market, start looking into creative financing, alternative financing.
Yes. I forgot that term, creative financing. That's right. And you just don't hear about that much anymore.
Because we had rates so low for so long, you didn't really need to get creative.
I think one of the keys is to figure out the purpose of why you want to buy the house, and then realize that if you are in a financial position to buy the house and you understand why you want to buy the house, it doesn't matter what the market is doing. You need a plan, and you need to figure out how you're going to make that happen, and then figure out how you're going to take advantage of things when the market changes. So yeah, but it really comes down to, do you understand why you want to buy the house? Do you know your numbers? And realizing that, and kind of getting out of this idea that you're going to magically buy at exactly the perfect time to make all your dreams come true.
I can imagine too, Mindy, that many realtors would say, you know what, Miranda, housing prices never go down. So you may not want to buy now, but that house isn't going to be less next week or next month or next year. It's going to be more. So you should go ahead and buy it now. I mean, and obviously we all do know houses did go down in 2009. But what do you think about that, Mindy, that argument? You're going to buy it. It's going to go up. Just buy it. Just deal.
So I want to tag on both with what you just said and what Miranda said. She said, what is your purpose for buying the house? And back in 2022, when everybody was so crazy to buy a house, and then they were bidding over asking and waiving their appraisal and inspections and all of this stuff, you started hearing towards the end of 2022 all of this buyer's remorse. Oh, I felt like I had to offer more than the list price so I could get it. And now there's things wrong with the house that I didn't know about because I didn't get a home inspection, and I don't have any money to fix it because I spent all my money on the house. So understanding your motivation for buying the house, there were also people who were like, oh, everybody else is buying, I should buy too. Miranda, if you want to be a renter from now until the end of time, then be a renter from now until the end of time.
100%.
It is perfectly valid to not own a house.
Well, if you don't want to own a house, Miranda, why did you bring this up? Oh, wait.
She wanted to talk to me.
Oh, wait, I brought it up. But yeah,
and then what you said. So right now, real estate agents are throwing around this phrase that I really, really hate. It's marry the house and date the rate. I'm like, that doesn't even make any sense. But
I love it so much.
I
love it so much.
What do you mean date the rate? Whatever. But right now, there are people who literally cannot afford the monthly payment that it would cost them if they bought with these rates. So they're sitting on the sidelines and they're renting. If you buy a house with a 7% or whatever rate that you can afford the monthly payment for the foreseeable future, and then rates come down, you're the only person in that house who's refinancing that mortgage. So if rates come down, you'll be able to get a lower rate. If rates do come down and you didn't jump in, and now all of a sudden you're jumping in with a lot of other people who are also jumping in. And I truly believe that should rates come down, all of these buyers are going to jump back into the market, and that's going to drive up demand, supply and demand. When supply is low and demand is high, prices go up. I don't see prices coming down. Back in 2008, that was a mortgage-driven crisis, and we had plenty of inventory going into that. So prices went down because there were no demand. But now we don't have any supply, and demand is steady, and demand is only going to go up when rates come down. So if you are thinking that you truly want to own a house and you can afford the mortgage payment right now is actually a good time to buy, because your competition is a little bit less than it will be should rates come down.
That makes sense. And, by the way, let me throw in a word of caution going back to the great housing crisis because I live in South Florida. My house went literally down and half its value was gone. Now it's 3 times that, but whatever. Point is, what a lot of people did then, though, they were so happy to be able to get a mortgage. And what they would do, they'd buy adjustable rates because it had a lower interest rate initially. And then 3 years later, the interest rate goes up a ton. And now they can't afford their house anymore. And I did television news. I would stand there on camera with this hapless homeowner, and they'd be like, they didn't tell me the interest rate was going to go up, and now I can't afford my house. I'm like, well, then you're an idiot, because you should have read the goddamn mortgage. You don't enter into a loan for $500,000 without understanding what the terms of it are. But this is another technique people could use, though, to get a lower rate, right? Get an adjustable rate mortgage. I think it's a bad idea. But it is an idea. I mean, if you're gonna leave 3 years from now, and you can get a 5-year adjustable, and get a lower rate as a result today, do adjustable rates, are they even lower now?
Adjustable rates are lower, and this is one of the options that my go-to lender is sharing with my buyers, is that you could have an adjustable rate and a lower rate right now. But that's 7 years. And in 7 years, your rate will adjust to whatever the current market is. It could be up, it could be down. You don't know. We cannot predict it. So be prepared for it to go up. The adjustable rates back when loans were 3-4%, that was a silly option.
Yeah.
You're only saving a tiny little bit, and there is the option for it to go up. When rates have started to go up, that's when the adjustable rate became a lot more common. But you made a good point. People traditionally move every 5 to 7 years. So if you're not going to plan on being in this house for, 7 years, and you get a 7-year ARM or adjustable rate mortgage, then great. You'll be able to get out before your rate potentially goes up. And you're not locked into that 7 years. If rates start to go down in 5 years, you could refinance to a fixed rate mortgage. I had a house that I owned for 5 years. I think I refinanced the mortgage 3 or 4 times because rates kept going down, and I like a lower payment more than a higher payment.
Yeah, and in this state, it's expensive to refinance. Thousands of dollars for
yes.
Title insurance, blah, blah, blah.
Yes.
So, you have to take that into consideration too when you're going to refinance because it ain't free.
Right.
It isn't free, and you want to do you don't want to go from a 7% rate to a 6.9.
Mm-hmm.
That's not worth refinancing for. Run the math and see what your payment, how much lower your payment will be, and also how long it'll take you to make up the difference. If your payment is $100 less and it's going to take you a year to recoup the cost because it costs $1,000, go nuts. Absolutely refinance, especially if you're going to be there long term.
Yeah.
But if you're not, like, there's all these moving parts. I keep saying there's all these moving parts and perfect storms, but you really have to take into consideration and be thoughtful. And back to Miranda's word, you have to have a plan in place.
Okay. Well, we have come up with some options that you could at least look at or explore. Now, if we're kind of done with this topic, I want to ask you something else. Let's call this like a bonus thing. I want to ask you about being a realtor with the new law, or not the new law, the lawsuit, I should say, against the National Association of Realtors. One of my good friends is a very successful realtor here in Fort Lauderdale, and I was just talking to her about this too. It looks like, and as a seller of homes, I'm pissed paying 6%. I mean, I'm selling $1 million home, and that sounds extravagant to many of our listeners, I'm sure, but I live in Fort Lauderdale. It's expensive as hell. But if I'm selling a $100 million house, I'm paying $60,000 in commission. And now this lawsuit has happened with the National Association of Realtors, where they're saying that it's not my responsibility to pay the buyer's agent. So you represent buyers a lot, right, Mindy?
I am primarily a buyer's agent. I don't do a lot with sellers.
What are you going to do? And none of this is gelled really yet. I mean, and everyone's talking about all the different options. But if I'm looking for a house today and you're my agent, should I try to negotiate with you how much I'm going to pay you? What should I do?
So I am a bit of an anomaly when it comes to real estate agents. I have the job at BiggerPockets, so real estate agent work is kind of my side gig. I love seeing houses, which is why I work with buyers. And right now, that ruling hasn't gone into effect. It doesn't go into effect until July.
Right.
In July, you're going to start seeing a lot of properties on the MLS that offer 0% commission to the buyer's agent. And this is a good on paper, but nobody thought it through kind of decision, because right now when a seller can offer whatever commission they want. That's the thing that they're not really covering, is that this law isn't changing anything. Commissions were always negotiable. But what I charge is X percent. And you can say, Mindy, I would like you to take less than that. And I can either say yes or no. And if I say no and you don't want to pay X percent, you can go find another agent. There are lots of agents who are flexible in what they charge. The way that it is currently set up is that, Stacy, you list with me and you pay me, let's use your 6%, you pay me 6%. You're not paying the buyer's agent. You're paying me, your listing agent. Me, your listing agent, is then giving a commission to the buyer's agent. So technically, the seller was never paying the buyer's agent. The seller was paying their agent, and their agent was paying the buyer's agent. But we both know this is semantics. You're paying the buyer's agent
Right.
and the seller's agent. Where NAR got into trouble was that they own every MLS in the country. And in the MLS, you have to, as the listing agent, you have to enter some form of buyer's agent commission. And that was required. That was a red star in the field. You have to enter this information in. And that is then considered price fixing under the Sherman Antitrust Act. And I know this is getting like super into the weeds, but one of the provisions is that now they have to take that out, and I can enter 0 into there. Whereas before I would have to enter like $1 or something, which again is semantics. But what's happening, or what will happen, I believe, is that buyer's agents will see that Stacy is now offering 0% commission, but Aaron, same house, same block, just down the road, is offering the traditional commission. Aaron's house is going to get viewed a lot more than your house is, because while agents are required to show all the houses that their buyers want to see, they're not required to show them in any particular order. So they're going to show Aaron's house first, and then your house, maybe if we don't like any of the other houses, but they're going to show Aaron's house first. Aaron's got the same house you do. They're going to buy Aaron's house, and your house is going to sit on the market. And this is unfortunate and kind of unfair for the seller to have to foot all the bills.
Yeah. Well, I'm digressing. Actually, Mindy, would you do me a favor? Would you promise to come back after the smoke clears on this? Because this is a whole topic for a podcast, I think, this whole thing that's going on. Because it's monumental. It's a huge shakeup of the real estate industry.
On paper, it is a huge shakeup, but I'm wondering how many actual real life changes are going to happen. And Stacy, I will come back and talk to you about anything at any time.
Listen to you. This is how you're getting invited to everybody's podcast. Okay, guys, we are out of time for real. But we are never out of topic, folks. So dig a little deeper. You're going to find links to lots more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, then your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. It's a rental. That is mirandamarquit.com, Marquit. And of course, you want to visit Mindy at her website right this second. Well, as soon as I stop talking. That is BiggerPockets.com. If you got a question, comment, or topic you'd like to suggest, tell us about it. You can email us at hello@moneytalksnews.com. And last but definitely not least, if you like what we do something for us. Subscribe to our podcast. Tell your friends. Post it on social. Just do something to make me richer, would you? Mindy, I'm laughing at myself. Mindy, thank you so much for being here. We love having you, and you know that, and we count the minutes until you return.
Stacy, I love joining you. Thank you so much.
I want to be on your podcast. Oh, I'll beg for that after we get off the air. I'm Stacy Johnson.
I'm Miranda Marquit.
I'm Aaron Freeman.
Thanks for hanging out with us, folks. We're going to see you right here next time.